Hi everyone, welcome. John and Trent here. Thanks for taking the time to look at this video. We wanted to reach out and just talk with you a little bit about what's going on in the market and the economy. You've heard a lot about rising interest rates and inflation and the war in Ukraine. All these things are getting talked about in the media. We wanted to kind of break it down for you today and just give you our perspective on what we think is happening and what's possibly around the corner. So Trent, I'm going to start with asking you the toughest questions, like what are we in right now? What's going on? Why is the market down?
Sure. I think it's important to, remember that we've just come out of a pandemic. And everything that we're kind of seeing right now are effects of the pandemic and the policies that were used to try and help mitigate the pandemic.
Okay, so when we look at what the Fed has done recently, they've been aggressive at raising interest rates. So how do you feel they've handled that? I mean, did they come in a little bit too late, too early, too much? What's your perspective on
Sure.
that?
Hindsight is always 2020, and looking back, they probably came in too late. And then in order to correct that, they've come in much harder than what people were expecting. And so that's definitely led to a lot of volatility in both the stock and bond market.
So by doing that, there's been this cause or concern that, okay, they're raising rates, they're tapping the brakes a little heavier than we thought they were, so they might know something we don't know, but it's really more just timing. They came in a little bit too late, and it's putting a stall on the markets.
Exactly, and they've definitely said that they want to handle inflation. And, as they do that, their only real tool is to raise interest rates, and that inherently slows down the economy.
Yeah. Well, it's good for our retired clients who have money in money market accounts, because now we're back to getting a couple percent, which is we haven't seen that for many, many years.
Yes.
So that's great. I think our money market account's paying 2.25 or something like that, which is good. So for the savings client, that's a good thing. So what does that mean for recession? You hear this tossed around all the time. Are we in a recession? Are we going to go into a recession? How bad is it going to be? And where are we at?
Sure. Well, we don't think we're in a recession right now. We've had a lot of positive economic data for the beginning part of this year, and it shows that the economy has slowed, but that we're not in a recession yet. However, because of the Fed raising interest rates as aggressively as they have, and we do expect them to continue, although at a slower pace, rise interest rates, that we are going to more likely than not experience a recession, either starting the fourth quarter of this year or starting into next year.
Okay. So the recession, we think of that from past times like 08, 09, and previous to that in the 90s and the 80s, it was a dark time. So is this going to be significantly worse than what has happened in the past? Is it going to be a mild recession? What can we expect?
Sure. We do expect it to be a very very shallow recession. It's not going to be anything like 2008. We're going to have data that's going to show that it's sometimes some quarters might be a little positive, might be a little negative, but throughout the course of that time, it's going to be fairly flat.
Okay.
So it's going to be a shallow recession, and we're hoping that through the end of next year we'll be able to recover from that.
So this year's been a tough year for the bond market because of the rising interest rates that happened very quickly caused bonds to go down, and we've always used bonds as a hedge against a negative stock market. So we got a double whammy this year. We got stocks down, the post-COVID hangover, and then we've also got rising interest rates, so that's affected our bond portfolios. But has that stopped now? Has most of the damage in the bond market been done, and we expect a more stable bond market?
Yes, yeah. We think that bonds could go down a little bit. They could go up some. We're kind of in that. We're kind of back to normalized interest rates for bonds. And the other bright side of that is bonds are now paying much more than they were in the past. It's something that we've adjusted our portfolios for in knowing that this was going to happen, and we're now at a point where we don't think we need to do too much more adjusting.
Okay, and I know you made some adjustments earlier in the year on portfolios with shorter duration bonds to withstand the rising interest rates. What about on equities? What's been the shift? It's been a growth market for a long time, and the growth stocks have always outperformed value stocks. So and I think there's a shift, and we've talked about this in years past, that we're going to eventually move to a more value market. So are we there now?
Yes, I think we're there. We've seen value definitely outperform this year, and you have to kind of think about the reason why growth has outperformed so much over the past 10 years. And part of that has been low interest rates. Growth stocks' value is in their future earnings. So when you have very low interest rates, those future earnings are worth more. When you have high interest rates, those future earnings are worth less. So that puts value stocks in a little bit of an advantage. Plus, typically coming out of a recession, we do see value outperform. So both of those are going to lead to probably this year, next year, value outperforming.
So what we've often seen in the past is in a recession or in a flat market, you might find the stock market all of a sudden to take off for no apparent reason. You know, the markets look all of a sudden bright, but the economy is still in tough shape. So maybe explain how that works.
Sure. Well, the market's very forward-looking, and when the market can kind of see what the future outcome is going to be, then it starts to make a correction. You know, we saw that this year as well. We've seen the market go down dramatically even before we've hit this recession. And on the other side of that, when we're probably in the middle of a recession, we're going to get enough economic data that's going to show that there's a light at the end of the tunnel and that the market's going to react positively.
And let's hope the light at the end of the tunnel is not a train.
Definitely.
So one of the things I've learned over the last several decades, is that it's important to stay invested, because the uptick doesn't happen over 6 or 8 months or 12 months. It can happen in a matter of days. I mean,
Yes.
all of a sudden, and we saw it this last week. You know, we saw the market all of a sudden pop above 30,000 on the Dow, and it just all of a couple of good days makes a big difference. So we think it's important to stay invested, but this is the time that challenges clients.
Yes.
So when we are looking at the next year or two, you think, well, if it's going to be tough, should we be making changes now?
Sure. Well, you know, we definitely don't want people to take a look at the idea of, oh, if we think we're in a recession, we should start selling stocks, because all of that data has already been built into the stock market. Again, the stock market understands and has forecasted that, and so they've adjusted the prices. So we want to stay fully invested. Now, we have made changes to the portfolio leading up to this, little changes to kind of prepare the portfolio for what we expect to happen. And we're going to continue to do so. You know, we think there will probably be some opportunities that we'll want to make some changes going forward as we start to get into this recession.
So maybe some opportunities on the table right now.
Yes.
Both in the stock and the bond market. So it's always a good time to invest.
Yes.
And you know, we never know which day is the best, but over the next 6 to 12 months might be a good investment platform. Thinking out again 5 years could be very, very good. So
We've had a drawback in the stock market, and so the future expected returns of the stock market are much higher than they were last year.
I think we looked at that about a year ago, and the 5-year forward projections on a 60-40 portfolio were in the 7% range, maybe 6.5%, something like that. Where are they now?
Right. So I would even say I think they were probably even lower than that at that time. And now, so they were probably 5.5%, 6%, and now they're back up to their more normal 7, 8% range.
Okay, that's great. Well, I think that probably covers most of our information we want to share with you today. Again, we apologize for a tough year, but and we appreciate the fact that you've got a cast iron stomach to weather through the difficult times, and we've all been through this before. So it's one of those things that we just, there will be sunnier days ahead, and we are here. If you have any questions, make sure you reach out to us, and we'll look forward to seeing you sometime soon. Thank you.
Thank you.